Sky News Business presents the following hour with live captioning for all Foxtel and Austar viewers. The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Hello, welcome to the program. While Janine Perrott takes a break, we're using this opportunity to answer your questions about money. This is your chance to ask anything at all that has to do with your finances, your career, your investments, or if you've got questions about the bigger picture, anything you don't really understand, you can email us yourmoney@skynews.com.au and we'll find an expert to answer it for you. Now, tonight we're going to bring together a lot of the questions that we've been getting to do with bonds and debt markets. A lot of people interested in investing in this asset class but feel they don't really know enough about it. While the use of bonds as part of a financial retirement plan is quite common, many people remain pretty much in the dark about how they actually work. They're not the typical high-risk, high-yield investment. They're designed to earn a return for you that's probably a little bit more stable than some of the other asset classes out there. Let's kick off with our first viewer question tonight. It comes from Sophie in Willoughby. It's a pretty basic one. She's a 59-year-old, single, due to retire in the next 12 months. She says, for the first time ever, I've been advised to go and see a financial planner. Better late than never. Before I do that, I just wanted to get a better understanding of what a bond actually is. I always hear about stocks and bonds, but really don't know what the difference is. I have savings in my super fund and in the bank, but that's it. To help us answer all this evening's questions, Jim Stening is here. He's the Managing Director of FIIG Securities, and Adam Donaldson, Head of Debt Research at Commonwealth Bank. Gentlemen, thank you both very much for coming in.
Thank you for having us.
Jim, I'll start with you because you're the one sitting there with a big frame. I guess where we should start is what actually is a bond? How do they work?
That's a question I get asked a lot, and I thought, as I was walking out of my office, I thought it'd be useful to grab one of these bonds off the wall and bring it in and show people. So I brought along a bond with me tonight. Basically,
they don't necessarily look like this anymore.
No, they don't. They were very ornate in the old days. I should mention this was issued in 1908. It's actually a Russian bond. But essentially a bond is an IOU or an obligation to pay the holder of this piece of paper an amount at a certain future date. The other part of this document shows what is called coupons. Or interest payments. So there's also an obligation to make payments on the bond over the life of the bond. So fundamentally, the big document basically outlines when you're going to get your money back. It also outlines the terms of the loan. So in this case, 5%. I can't help you with many of the others because it's in Russian, other details. But and then the coupon. So in the old days, you would go along with one of these coupons when they were payable, present them, and the register would give you the cash or pay you the money that you were owed. Interestingly, in this example, there was a little old thing called the Russian Revolution in 1917. So that's why on this example, I still have about 22 coupons left.
It's interesting. I mean, so what's happened there is it's defaulted, and these are the conversations we're still having today. Is that you know, all you're really doing when you're buying a bond is lending a company money, and they're promising to pay you it back. And then this is the risk you take, that at some point down the track they might not be able to afford. There's your risk.
That's right. Like I said, this is a bad example.
Yeah.
I mean, most governments don't default, but yeah, this is a classic.
They would have had a AAA rating. Well, maybe
I don't think they would have. No.
We'll talk about ratings a little bit later. Adam, talk us through, I suppose, some of the key features of a bond. I guess what a lot of people don't understand is how they're different to shares. So how do they work? It's not something that you necessarily, they're not as liquid necessarily.
No, they're not as liquid. Typically they are an over-the-counter market, and there's a very vast international wholesale market that trades in the trillions of dollars every day in these securities. In Australia, we do have a small retail market, and there are some bonds that are listed with the stock exchange, and through your broker or a private bank and so on, you can certainly purchase those securities, and generally you can sell them back as well. I guess the distinguishing feature of a bond compared to something like stocks or equities is, of course, that there is a maturity date. So you might buy it in the knowledge that in November 2016 you're going to get your $1,000 back. And the question you're facing each time you try and make that decision is, well, am I able to purchase that bond or security for a discount now, so that I'm earning a return over and above perhaps the coupon that is available? Almost every bond will have a coupon. Perhaps it's paying 5% twice a year, but the price of a bond between now and that date in 2016 can vary according to the supply and the demand, in a bit the same way, I suppose, that an equity does.
So it's similar to shares in that way, is when you buy the bond, the actual price may change for you, but the rate of return is fixed, and the period that the bonds are on issue are fixed.
That's right. If you're going to hold it until maturity, that date in 2016 perhaps, then you know with certainty you'll be getting your $100 or $1,000 back. What you don't know is if you want to sell it in 2014, whether somebody in the marketplace will be wanting to bid you $95 instead of that $100. So there can be some variations in price. But for long-term investors, of course, what you're seeing is a safe place to park your money and a steady return over that period, and that's very important in obviously volatile markets.
Jim, what are the sorts of types of bonds that are available to retail investors?
Well, it's interesting. I mean, predominantly the market is wholesale market. There are a number of listed bonds on the ASX, and there's actually a range of interest rate assets that are, I suppose, broadly defined as bonds. Look, I think predominantly, though, on the listed market or the market that retail has complete access to, a lot of those issues are what I would call high yield and probably more akin to equities. A lot of the hybrids, I suppose, issued by larger organisations would probably qualify more towards debt. But the reality is, I mean, the price action through the GFC really, I suppose, demonstrated the high risk of those types of investments. In terms of the broader market, I think what we've been doing is developing access for people. I mean, particularly the self-managed super fund and investors and wholesale investors into smaller parcels of over-the-counter bonds. And so there's a broad range of investments available there. Obviously, Commonwealth governments, state government bonds, some corporates, for example, Telstra, GE Capital, those types of bonds, through to, again, the regulated entities, so insurance companies, banks, regional banks.
Can I just jump in, Adam? Maybe you could just explain what a hybrid is before we go too far.
Yes, a hybrid is a security where, when they were originally developed, you're being paid a coupon every 6 months or so, but the risk attached to that security is that at some stage in the future the company may, for example, decide to convert that hybrid to an equity. So you lose that certainty of knowing when the final maturity date is.
But you would hope that the upside for the reward is obviously a little bit more as well.
Well, that's right, yeah. And typically they are, as Jim said, higher yielding over time, so the reward is there.
So, guys, when we talk about, we report these things on Sky News Business all the time. Fortescue has decided to do a multi-billion-dollar issue, and we give the prices and we talk about, how much it's going to be priced above the bond rate, which is, all this stuff. Is it then easy for, Mum and Dad, Joe Blow, to go to their broker or whoever and say, well, I want in on that?
Well, I mean, it depends. That's the answer to that. Look, I think there's probably more ability to participate in the secondary market. A lot of those issues happen offshore and probably don't see the light of day even for Australian wholesale investors. So, it's certainly worth asking about.
And just before we move on to the next question, I just wanted to ask you as well, there are, for retail investors, ways of accessing the bond market which are probably a little bit easier than that. There's a lot of bond funds where you actually have a fund manager who'll get all the, they're in the wholesale markets and they're getting access to all these different types of debt. And what you're doing is just you know, purchasing however many thousands of dollars worth of sort of exposure to those. Is that probably, for people who don't have a great understanding, the best way to go about it?
Yeah, that is the most common way that investors do have access to the fixed income market, and in many instances, I suppose, investors just tick the box and select a balanced fund, and within that you might find that there's a 10 or 20% exposure to fixed income or bonds. Alternatively, of course, they can often choose the allocation, and they can increase that exposure if they want as well. Many of our clients are those fund managers who are investing on behalf of fund holders. And yes, they're you know, very, very professional investors who are able to assess the relative value between different corporates who are issuing paper, or perhaps between corporates and the government and so on. And of course assessing the interest rate outlook and the inflation outlook and those type of things as well.
I'm going to stop asking questions because we've got lots from viewers to get through. Richard in Manly writes, I have long been interested in investing in bonds, but I'm not really sure how I should go about it. Can I use an online trading platform, or do I need to have a broker? Do I also need to wait for an issue, or can I buy them at any time? We've sort of covered some of those, but Jim, do you want to have a crack first of all, the online thing?
As far as the ASX listed offerings go, obviously there's complete access to those assets through an online broking platform.
So just give us an example. I'm not asking you to promote anything.
If you wanted to buy CBA senior FRNs, then you can press buttons on whatever online broker you want to achieve that. The larger market is, of course, the over-the-counter market, and you do need to use a broker to access that market.
Okay. Adam, what about the sense of timing? Does he need to wait for an issue, or we kind of discussed that, but...
Yeah, look, it can often be easier to get access when there is an issue being done, and private banks or brokers will often have an allocation through those issues and be looking for demand in the marketplace. So that is an easy way. But your ability to choose the names is highly just dependent on who is coming to the market. Whereas, of course, an investor seeking diversification, they'll be wanting to make their own choice, and to do that, often you'll be looking for the secondary market.
So it's like an IPO. It's the same as, you know, if you've got a good broker, they're probably likely to get good parcels of stuff in an IPO, and you're more likely to be able to get involved than...
It's exactly like the equity market. You have a strong secondary market, and you have new issues coming to the market.
Yeah. Okay, third question on bonds comes from David in Stanwell Tops. He writes, I have inherited a bunch of bonds. Is that the...
Very
that's the technical term. That's the collective for bonds is a bunch.
Portfolio.
From my grandfather, but I could really use the money from them now. Am I able to on-sell the notes, and if so, how?
Again, I mean, generally speaking, I think the answer is yes. I'd imagine that his grandfather was a fairly conservative investor, but you know, it depends on the issuer of the bonds. I mean, if they're Greek sovereign debt, well, there might be a little bit of a problem getting some liquidity there. But if they're obviously Australian bonds or state government bonds, then there's a ready market, very liquid market for those types of assets.
Well, I suppose a lot is going to depend on how big that bunch is. Clearly, for larger volumes, then you're more readily able to find a buyer. I suppose small parcels are more difficult.
I just want to go back to, we touched on the bond funds that are out there, and just a question I think might interest some people is, you know, if you're going to invest in it, it's technically it's a managed fund, so it doesn't really matter what sort of assets. You've got managed funds that cover all sorts of assets. We know bonds tend to be, you would hope, a little less risky. How can you compare, what sort of potential upside, downside are there in a bond fund, say, as compared to a straight equities fund? I know it's a difficult question because they're all very different, but just, you know, in general terms, what sort of returns are you looking at from your average bond fund compared to your average equity fund?
Yeah, I think in the Australian context, if we think about Australian bonds, you can pretty much rely on perhaps a return per year of 4 to 8%. Very good years, it could be a little bit more than that, and in bad years a little bit less, but that's quite steady. Whereas, of course, when you're talking equities, you know, we've had returns in some years of 30%, positive and negative, and really what you're getting with your fixed income exposure is that steady state of return and confidence that the capital value will be preserved. Now, when we think about those numbers, the volatility is, as we said, much greater in equities, and most people have the impression that over time the return is therefore much greater as well. Depending on how you measure these things and what date you choose to start your comparison from, that hasn't actually necessarily been the case in Australia. For example, over the last 5 years or so, your average bond fund has returned something like 6.5%, and the equity market is much weaker than that.
You guys, I have this conversation when you get the equity guys, they come like, why would you invest in bonds? I mean, we could just say, you know, all the figures say that we would do better. We do have to take a short break. I'm running over. We've got lots of questions to get through. Coming up next, we're going to tackle some of the more complex questions surrounding debt investing. Stay with us.
Confidence. It's something you can't always see or hear, but you can most certainly feel it. It's there as you head into every corner or every drizzle-drenched straight. Confidence is in Subaru's DNA. It's our boxer engine, symmetrical all-wheel drive, 5-star safety rating. Now look, and they come as standard with every Subaru Liberty. Subaru, all for the driver.
So I have a great idea.
Simple online collaboration will change the way you work. And perhaps a whole lot more. Visit gotomeeting.com.au and sign up for your free 30-day trial.
Welcome back. This is Your Money on Demand, a chance while Janine Perrott is taking a break for you to ask us anything at all about money. If you've got a question you'd like us to find an answer to, email us yourmoney@skynews.com.au. We're talking bonds tonight because we've had plenty of questions about them, so we thought we'd get some experts in and go through all of them in one hit. Our next viewer question on the bond market comes from Tim in Nundle. He writes, what impact will the stalemate over the US debt ceiling have on Australia's bond market? Who wants to have a shot at that?
I'll have a shot at that.
Adam Donaldson from CBA.
We're getting a lot of those questions at the moment, of course, and unfortunately it's not one of those ones where you can give a categoric answer. I guess the way we're approaching this issue is firstly to think about the people involved. There are a few politicians who have incredibly high stakes in this game that has been played. It is a game of politics more than it is a game of finance. The US, perhaps unlike Russia in the past, has ample funds available to pay the obligations that are due. But there's a political ceiling that has been put in place that means they are not going to be able to borrow more money, and in the short term that may mean that they don't repay some of the securities that they owe. Now, because it is a political issue rather than a broader finance issue, our expectation is that it will be resolved, and we actually think that the odds of a default are pretty low, and we've been suggesting perhaps 5 or 10%, but again, it's a people issue. Even if it happens, we would suspect that then politicians will get into gear pretty quickly. So markets aren't necessarily on a trajectory of a tremendous downhill run because on one particular day the government of the US is not meeting its obligations. But if it were an issue that was going to continue on and on, then problems would certainly arise. And it's going to be a problem for riskier assets. So, you know, we're talking about the US Treasury and bonds, but assets like equities and corporate bonds and so on actually will be caught up in this because risk aversion will be quite high and people will be battening down the hatches. In the Australian context, we could be caught up in some of that volatility. What we have seen in recent times is, in actual fact, Australian bond yields have declined because there's been a flight to quality markets, and Australia, being a very firm AAA government that won't miss a payment, is in the upper echelon of of economies and a very secure fund. So we think the flow-on effects to here from that turbulence would be minor, and in an economic context probably reasonably minor as well.
Jim, this is probably a good opportunity just to bring in the role of the ratings agencies. As an example, today we saw Fitch put Queensland on a negative outlook. Now, this is not a downgrade, but it's saying that the challenges in Queensland are making things a little bit more tough. The other issue, I suppose, we have with the ratings agency is post the GFC. They certainly came in for a lot of flack. So, how critical are those ratings and those statements that they put out? They're back in the spotlight in the last couple of months with this issue in the US, and obviously, you know, Ireland and Greece and half of Europe. I mean,
well, I think, you know,
how important are they, and how important these letters that we see after the names?
Well, in terms of assessing sovereign debt, I mean, that's a core competency of the rating agencies and has been for a long time. So there is serious gravitas given to their views. I suppose, you know, it's in terms of this potential for downgrade of the US. I mean, this has never happened before, and so it's kind of easy in a way to try and dismiss the rating agencies, but you can't have your cake and you eat it too. I think one of the things that's probably hasn't been explored enough is that how entrenched these ratings really are globally in terms of investment practices. So. And what it means in technical terms for other issuers within the United States and for investment mandates globally. So I think, you know, it may be that if the rating is lost in the US, that certain funds can't buy those assets globally. So there is a turmoil, a complete unknown, in that a lot of it's written into legal contracts and documents that really can cause problems. So overall, I think the environment we're moving into is one where allocation to risk assets, you need to be making that decision on the basis that there's going to be ongoing turmoil in terms of sovereign debt, not just necessarily in the US. I mean, there's problems emerging in the UK. There's an ongoing death of 1,000 cuts happening in Europe. So it's a very volatile environment.
In a nutshell, an investor, you know, a retiree who's got, say, the majority of their money tied up in US government bonds, it's highly unlikely it's all going to go pear-shaped and they're never going to get anything back. Let's just...
Absolutely, yeah. Look, I certainly don't subscribe to that, but I think one of the things with this sort of brinksmanship, or if you like, game of chicken that's going on, is that it just creates uncertainty. And I think a really bad outcome would be for this to just be deferred over the short term. You know, kick the can down the road, sort of thing, and on we go. I mean, there really does need to be. You know, unfortunately, a step away from the political, a political type of solution. It's hard to see that happening in any of the sovereign issues.
So many things, couldn't you?
Yeah.
We need to move on because we have another question here, and I've lost who it's from. But the question is: given that bonds have a fixed rate of return, they're of course. Oh no, this. I'm not sure what this is, but anyway, our next viewer question comes from Emma in Dulwich Hill. And she writes, I've always wanted to invest in bonds, but I'm worried about the risks of rising inflation and interest rates. Is there any way to protect against these two things? Adam?
It's a very good question. Inflation is in many ways the enemy of bonds. If you buy a security today and you've worked out that it's going to be delivering you a yield of 6%, and you're used to inflation of 2%, then you're getting a real return of 4%. But of course, if that inflation rate moves up to 6%, then effectively your real return is 0. So that is where some of the risk in bonds arises from. There are a couple of ways to protect against that. One is that various issuers, including the Commonwealth Government and the state governments in Australia, issue inflation-protected securities. And in those, the rate of coupon payments will vary according to the rate of inflation, or it might be that the capital value at the end is adjusted because of inflation moves. But that impact of inflation is taken into account, but the real return that you receive, you still know what you're going to get.
I would presume you pay extra for the benefit of that?
Well, you not necessarily, no, but your real return may be a little bit less than it can be in some other bonds.
So you do pay extra.
Well, yeah, it's what you're effectively doing is you can look at these securities, and for example, at the moment, you'd be able to work out, okay, the market is pricing in an inflation rate of 2.8% on average for the next 10 years. And you can say, well, I think that number's too low. You can buy in full knowledge that you're going to get a real yield of something like 2.5%. It is what it is. Okay. There is another tool actually available as well, and that is what we call floating rate notes. And these are notes that are more tied to instruments that vary in line with the cash rate in Australia. If that cash rate goes up or down, then the yield or the coupon you receive is going up or down, but the margin above that, which is the credit exposure you're taking, is fixed.
Yeah, I mean, I think it's an interesting point. I mean, people probably use an example like a mortgage. It's the inverse of that. If you think rates are going up, well, you can go to floating. If you think rates are going to fall, you can fix your investment rates. Lengthening or shortening your duration can protect against moves in underlying inflation and interest rates. So it's a bit of a myth, I think. I think it's probably perpetuated by the performance of a lot of the managed funds that are index-based when interest rates move up. In the direct market, there's an ability to avoid those types of capital losses.
Okay, we've just got a couple of minutes left, and Elise in Tamworth wants to know, this is becoming a bit like your money or call, but she wants to know what bonds are you recommending to clients right now? Jim, do you want to pick a winner or?
Yeah, well, look,
Queensland Treasury.
We're recommending a lot of inflation-linked bonds. So we're looking particularly at bonds. So there's one issued by Sydney Airport, another one Investra. The banks, CBA and ANZ, also Rabo, have inflation-linked bonds. These bonds are paying around 4 to 5.5% over inflation to investors. So that's a good place to start.
Look, we tend to think that corporate bonds are going to perform quite well in Australia. They do offer a premium, and that premium can be 1 to 2% above government bond yields, and because we think that the Australian economy is very firm and that profits in Australia are in good shape, that additional yield is quite attractive. And I guess we would also say that because Australian corporates are relatively under-geared at the moment and very cautious, there's quite a limited supply of those securities. So in the marketplace, the demand-supply mismatch looks quite favourable.
All right, gents, thank you very much. We've run out of time, unfortunately. I had heaps more questions, but I'll have to get you back. Jim, Adam, thank you.
Thanks for your time.
That is all we have time for in this edition of Your Money on Demand. Don't forget, if you have a question you'd like us to find an answer to, email us yourmoney@skynews.com.au. We've only got another 2 programs, I think, tomorrow, Thursday night, and Monday evening, and then Janine Perrott will be back in the chair on Tuesday. So if you've got anything you want to know about, get those questions in soon. I'm Kylie Merritt. Thank you very much for watching.